Traders looking to get into the most active stock options, they may face some of the biggest names driving the markets. And today we're going to walk through how to tackle these popular trades in the latest installment of Yahoo Finance's Options 101 Theme Week, sponsored by Tasty Trade. Joining us here to discuss is Danielle Shay, Simpler Trading VP of Options. Danielle, thank you for joining us here. Let me go to the Wi-Fi Interactive here so everybody can get on the same page. I was talking about some of the most popular options, and this is a snapshot a couple days ago. The 7 most popular, and guess what? There's a lot of overlap with the Mag 7 here. Tesla, that's number 1. AMD, Nvidia, Microsoft, Apple, Alphabet, Amazon. What do you think of this list here? How does it reflect what you're seeing in the options market and what's going on right now?
So I love your list. I think this is a great starting point for options traders, and these are the top stocks that I trade every single week. The reason why they're great is because they have a lot of liquidity, which means you can get in and out of options positions. They have a weekly options expiration series, so that means that you can take advantage of trades on a weekly basis, and specifically, you can take advantage of premium decay as it goes into the end of the week. And these are also the stocks that tend to be the most volatile in the stock market. So when you're trading options, you need to have some movement, and that's where it is.
All right, and we're going to talk about a couple of great examples. First, I want to bring the viewers up to speed with a definition. I know you like butterfly option spreads, and that's what we're looking at on the Wi-Fi Interactive here. And a couple of highlights. They combine both bull and bear spreads. You have basically 2 different spreads in each option. It's like a vertical spread, 2 of those. They have fixed risk and fixed maximum potential profit, so that's capped. Spreads use 4 options with three strike prices, and then there is an upper and lower strike price, which are equally distant from the middle at the money strike price. And a lot of words there. I think we're going to launch into an example, and here's your Microsoft example. This is a bullish call butterfly spread where you buy the 410, sell the 2 420s, and buy 1 430 call. That's a lot of numbers. Can you break them down for us?
Yes, definitely. So when you look at Microsoft, first of all, I love trading Microsoft. Microsoft just had earnings and it typically rallies after earnings. So with this trade, I'm looking at the stock and saying, you know what? I think Microsoft is going to trade up into $420 a share, most likely next week. So how can I trade this? The reason why I like butterflies is because they're incredibly cheap, especially compared to a long call. With this strategy, I can get in for $224 a contract. That was my entry price on this. Whereas if I was purchasing a long call, I'd probably have to pay $800, $1,000, $1,200 a contract, just depending on which strike you choose. So it's a really cheap way to get involved. And then the other reason why I like this is because of the risk to reward. So generally, if I'm spending $220, $240, the max profit is generally about 1 to 3, depending on where you get in. And so, if you're risking $250, your max profit's maybe around $750. And so with this kind of strategy, if you're good at technical analysis, you're really able to utilize your capital. So you're looking at a range-bound trade. You're saying, I think Microsoft is going to be between 410 and 420, ideally as close to 420 as possible, but I'll take it if it's 415.
And the prices are moving really quickly, as we were noting in our email exchange earlier today. I wanted to give another example here. This is your trade in Tesla. This has a bearish bias, and if we can go to the Wi-Fi Interactive, I have it pulled up here. You're buying the 185 put, you're selling 2 175s, and you're buying 165, the 165 put. Just break down your thinking here, please.
So with Tesla's been weak, and Tesla looks like it's ready to fall off a ledge at 185. So the way that I like to trade this is, again, setting up a butterfly. In this case, it's a bearish fly. What I generally do is I buy the long option just at the money or slightly out of the money, which is how I get into the strategy for such a cheap price. So I was looking at this one right before I came on. It was going for maybe $1.74 per contract. So for less than $200 a contract, you can get in short Tesla. If you bought just a put, it's going to cost you $800, $1,000, obviously, depending on which one you buy. So for this trade, looking at, minimum around $200 investment, and you can get about a 1 to 4 reward, if that trades into your zone. And as I was saying, I don't need it to go exactly to the target, but I do place the center strike of the butterfly at my price target. So just looking for it to fall about $12. That's why I put the center strike of my fly at about 175, and it's a cheap, low risk, high reward way to trade Tesla to the downside in case it rolls over.
Love that risk reward here with the butterfly trades. And you can even see the butterfly in those charts that were, if you squint a little bit. But before we go, I got to ask you one question I'm asking all of our options guests this week. What's your number one piece of advice for new options traders?
So for new options traders, you have to start out small. You know, when I started, I was trading a $5,000 account, and that was the reason why I got into trading butterflies to begin with. I could not afford, buying long calls on some of these really expensive names. So I would encourage traders to learn how to trade spreads. I know that it's challenging, and a lot of people say, oh, it's so over my head. But the reason why it's great, especially if you're learning, is because they're just so much more flexible. They're not going to move as much as a long call or a long put will, because you can trade in a range-bound manner. And you're also going to be able to risk a lot less money, which when you're starting out is very important, because you want to hold on to your powder so that you can keep trading and live to trade another day.
Exactly. Hold on to your powder. Most importantly, live to trade another day. Danielle Shay, thank you so much.
Thank you.
And stick around, more Yahoo Finance still to come.